Welcome to BQ Prime's earnings conversation with Blue Star, and I have with me Mr. Vir Advani, the company's managing director and vice chairman, to decode the fourth quarter results. Good morning, and thank you so much, Mr. Advani, for taking the time.
Morning. Thank you for having me.
Right. Blue Star has posted a good set of results in Q4. We have seen the company post revenues up 16%, which is ahead of the consensus estimates. The order book has increased 55%. Net profit has zoomed threefold, even without, adjusting the exceptional gains, it is still 40% higher. So, well, Mr. Advani, could you tell us if the demand that we have seen in Q4 also apparent in Q1?
Thank you, Cesar. So I'll just cover the full year as well. We had a very strong year. We crossed 8,000 crores of total income, which is a growth of about 32%. EBITDA grew to 493 crores. That was a growth of 42%. And our profit before tax, before exceptional items, grew to 385 crores, over 50% growth. The great thing about last year's performance is that all three of our segments did well. All three grew by over 30% in revenue and between 40 and 80% in segment results. So all around strong year for us. You also mentioned the carry forward order book grew by 55%. That augurs very well for FY24 as we look forward. You are asking a specific question about Q1. So Q4 was a good quarter. We are expecting a good Q1 as well. Of course, you know that both Q4 and Q1 are heavily dependent on summer sales. So both our room air conditioner business as well as our commercial refrigeration business are both very summer oriented businesses. There's been some talk in the news about March and April not being so hot, etc. Partially true. Yes, there are rains in north. It has been cool there. But, we are an all India player. South, East and West sales are good. And of course, at Blue Star, we look at the full season. We look at January to June as a 6-month season. And we're fairly confident that we should be able to grow by about 20% over last year.
All right. I would also like to know, like you already mentioned that despite the unseasonal rains, you still expect demand to be good. But how are you managing the inventories given that we are nearing the peak season?
Yeah, so of course, inventories are high, as would be expected. We have planned for that 20% growth and are expecting to do it. So we have inventory built up both in the field as well as in the factory. So but we're in the first week of May. May is expected to be a hot month. And last year, if you recall, June was a bit of a washout. It wasn't much sales. We hope that the summer continues through June this year. So we're confident that things will settle down and we'll have a good year and a good season more than anything overall.
All right. Mr. Advani, is that also a reason why your net borrowing during Q4 is high?
We ended the year net borrowings of 204 crores, up from 67 crores a year ago. So it's on account of two things. One is, of course, we had significant capital investment in the year. About 385 crores of capex is what we invested in a couple of factories. In fact, that capex is going to continue into FY24 because we are significantly increasing our capacity. In addition to that, you saw at a overall level with revenue growing about 32%, our working capital has also gone up. So it's a combination of working capital and capex, not particularly inventory specifically. We are comfortable with this level of net debt, and we expect that as the year progresses with capex continuing, the net debt levels will perhaps rise beyond this level.
Fair enough. In Q4, we have also seen your margins expand despite the higher expenses. So, do you think this is sustainable? And also, could you take us through the cost inflation and how it has an impact in your business?
Sure. So, if you look at gross margins, full year, we improved gross margins about 0.5%. Standalone Q4, you saw about a 2.7% improvement in gross margin. Now, I will point out that FY22 was one of the lowest gross margin levels we've had. There was severe supply chain constraints in FY22 that we had talked about at that time. Some of that eased off in FY23, of course, but really the majority of this improvement has been through a very large total cost management program that we've been running in the company, through which we've been able to redesign products, take out cost, optimize our material costs that goes into our products. So I think that's been the real reason for the gross margin improvement, which you've seen in Q4. We do expect gross margins to improve in FY24 from that low base of 22, improvement in 23, and expect to improve further in 24. If you look at operating margins in segment 1 and segment 2 full year, again, there was about a 0.5% improvement over the previous year. And in FY24, we are aiming to improve operating margins in our segments by another 0.5%.
Okay, and do you also plan to raise prices going forward as demand improves?
So we haven't done a price increase in some time. I don't think we need to at this point. As we've discussed, we're taking out costs from the product. We're getting operating leverage as volumes grow. So we are comfortable with steady improvement in operating margins. We're not looking to do any leaps or jumps. So I think we will selectively look at price increases at a product category level, depending on how margins are moving and how demand is moving. But really, in FY24, focus for us is volume growth, total cost management, a lot of investment in R&D and innovation that you would have seen. We have a large 100 crore grant from one of our promoters, our Chairman Emeritus, Mr. Ashok Advani. We'll be deploying that 100 crores into innovative products that will further both expand the markets that we serve, as well as reduce our total cost to the customer. So we're fairly confident of delivering improved financial results without necessarily only relying on price increases.
All right. Thank you so much for taking the time, and it's a pleasure talking to you, sir.
Thank you. Thanks so much.